higher to eat into the orders that are. And the idea is that you think that there is a more likely, okay, this is what you're going to have to subscribe to using these types of tools. What's more likely? That the market will start to go down to eat into the orders that are below the marketplace? Or is it more likely to go higher to eat into the orders that are above the marketplace? Well, I'm not concerned about those small little fluctuations in price. I mean, if you're sitting here trying to make 2 handles, 3 handles, those types of trades, and that's your mechanism to do those types of things, I'm not going to sit here and try to shoot holes through that, because this is simply, I would never do that. Okay, I'm not interested in that type of trading. I'm interested in knowing where the market's going to reach to, and I teach my students to focus on that primarily in the early stages of their development. Depth of market, or level 2 data, requires you still to have an opinion. And that opinion may be incorrect, much like my opinion about the marketplace using my own concepts may be incorrect. Just like anybody else, we're still met with the challenge of knowing the first rule and goal that I teach my students, which is to know where you trust that the market is more likely to draw to, higher or lower. And not just for the sake of a few handles, because the depth of market may imply that there's more buyers or sellers at any given time. Just because there may be printing a depth of market ladder, which is what these things are called over here, these are ladders, there may be more orders stacking above marketplace or below the marketplace. And the idea generally is it's more likely, doesn't mean it's going to happen, but it's more likely that the market will gravitate towards where the larger stacking of orders. If it's more likely that it's going to go higher, then the justification should be made that the depth of market, the level 2 data, that ladder should show a lot more orders to the upside. And then when it gets there, it should eat into that and start eroding those orders. That to me is something that is synonymous with having a crutch. And that's not to be derogatory. I don't mean it in a sense that, nobody should use crutches, while they're learning or while they're using their model. If you feel like these things are helpful to you and it helps you focus on sticking to one side of the marketplace, if you have a bias, if you have a draw on liquidity that you feel is going to be booked for that particular trading session or that day, and this helps you stay focused on it, then there's nothing to be worried about. There's nothing wrong about that. In my opinion, and this is all it is, and hopefully you can permit me to have my own opinion here, but the idea of using this stuff for the sole basis of whether you should be a buyer or seller is a little bit myopic, regardless of whether or not an XYZ trading firm or institution or bank or whatever has them on their terminals in their trading floor. It's irrelevant. The market still has that puzzle of where is it going to go, higher or lower. And when I teach my students to focus on where the most likely draw on liquidity is going to be, that's what you should be focusing on. Not all these little numbers in here on a footprint or over here worrying about is there more buyers or sellers above the marketplace, and it's likely to keep going up. And I watch a lot of YouTubers that use these types of tools over here, like the depth of market, the DOM. It's DOM, not dome. But the idea of using it, if you watch any YouTubers that have it on their charts or they're live streaming, or maybe they recorded their trades and they still have it on there, it doesn't appear, at least from my observations, it doesn't appear that it's all that helpful.
Getting a shipping quote just got so much easier. Your competitive shipping rate, lightning fast, quick quotes for full-fledged.
Even when I can see the market is likely to go higher or lower, and I'm viewing them live streaming or watch something in the past when I can see what the market has done because I've either traded it or I can pull it up in chart form. I can see how they can be tricked into thinking, oh, I think it's going to go to this price because there's a lot of orders around that price. And I want you to think about what it is I'm teaching you. We're not looking at the necessity for these types of things to confirm anything, because my assumptions are you're allowing the market to be seen visually in chart form, and yes, through a time-based chart. There's a lot of advantages if you understand what it is I'm teaching. There's a lot of advantages to using a time-based chart, where some other individuals out there that don't have a subscription to the same view that I have may not like a time-based chart, and they have to augment that data and create a new format of a bar or a candle or something to that effect. So just know, going into this discussion, I will be stating why I'm not a fan of this information or these tools. Do not let me change your mind if it feels like it helps you. If you're profitable and you feel comfortable using them, just because I may be your mentor, don't let me pry these things out of your hand. You may grow out of them on your own over time, or you may stick with them and it may be part of your repertoire. And there's nothing wrong with that as long as you're using them in a capacity that allows you to focus and allows you to trust your model. If that's what you're using them for, there's absolutely zero hindrances. There's nothing. I would never say anything adversely about it. But for someone to come out and say this is how you read institutional order flow. No, you're reading order flow, but institutional order flow is not. This is not institutional order flow to me. This is this reporting numbers that can be spoofed. That means that they can pull those orders. That means that you may see them flash on the screen, but doesn't necessarily mean when price gets to it that those orders are still there. Many trading firms and quote-unquote institutions have been fined many, many times over. Some of them are repeat offenders. Some of these trolls I've had over the years are actually guilty of this, and they were penalized for spoofing, messing around with placing orders in to make it look like there's a more stronger interest to buy or sell a particular vehicle or instrument or market. And if there's an opening for manipulation to the data, and that can absolutely be done here, how can you really, in my opinion, this is my opinion now, I'm not trying to convince you to not use these things, but this is my opinion, how can you trust the basis of this data if it absolutely can be manipulated? If it can be manipulated to make it look like there is a fake buying interest where orders can be placed above the market price or below the market price, and the interpretation of that would be seen collectively in retail trading as there's a lot of orders below or above the marketplace, and the tendency is to trust that it's going to more likely go to where there are more orders, and that's not necessarily what happens. Now, I'm sure some of you that use this stuff that don't like me, you're going to come out with 10 different examples of look where it worked, but I promise you, I can go on a live stream and show this stuff and it not working, where my stuff is absolutely running circles around it. So permit me to say that in this video, and I promise I won't be any more derogatory than that. But now from this point on, I want to kind of show you and compare and contrast what it is I'm trying to focus on in my teaching, so that way you're, as a student, you're looking at it the right way. And if you feel like, or you feel pressured by other people that will say you're not learning real order flow. No, we're not messing around with these things here. That's true, because it's not necessary. Because I want you to understand something. Listen to the name of this stuff here, okay? The footprint. That means you're looking at something that's already happened. How many orders were in this part of the candle, this part of the bar? Okay, it's already happened. Where have I ever told you to go into charts and say, here is how many buyers and sellers have been, so repeat what they've done or use that information? You never heard me say that. I'm always telling you to predict where price is going to go. And then where you think it's going to go, that draw on liquidity.
In every corner of our world, heroes are rising, created in the early mornings and late nights.
Above the marketplace or below the marketplace. It's going to go up to take out buy stops, or it's going to go up to reprice to an inefficiency, some kind of fair value gap or SIBI. Could be a volume imbalance. It could be a institutional order flow entry drill. It could be a consequent encroachment of a wick. There's very specific things that we're looking for, but not every single market at that time frame in that chart fractal, that portion of price that you're studying, is going to have every single thing that I have as a PD array, something that I teach you to focus on. But the ones that are actually there, you have to consider them and know what to do with them and navigate them. So I'm teaching you absolutely how to predict price, because how else are you going to use this information and trust it? I'll pose the question to you like this. If you are bearish on the marketplace, doesn't it make sense that if you're going to be using these tools that you're expecting the depth of market to show a lot more orders below the marketplace, a lot more interest to draw price into lower prices, because your bias, your directional bias, your analysis, you are bullish or bearish. So you're going to go into this data looking for those things to justify what? Your analysis. So I don't go to the middleman. These are all middleman ideas to me. And it's helpful in the beginning if you don't know what you're doing and how to navigate price action, and you want to see the underpinnings of what the market's doing and how it books price. That's wonderful. But my PD arrays are always ahead of this. It's always ahead of it. Look at what I did this week with the analysis on the July 9th, 2023 video I did on Sunday before the market opened up. I told you exactly what we would be seeing. I told you what would be expected in terms of price delivery, and it delivered perfectly, flawlessly. No necessity on having any of this stuff here. So really, I want you to compare and contrast. If this is measuring minute by minute, second by second, real events of transactions, because that's what this all is showing you, is transactions. But just because there was a certain number of buyers or sellers at a particular price at any given time, and just because there are more orders above or below the market price in the DOM, has absolutely no bearing on future price. It has absolutely no bearing on the future direction of price. The market could stay stagnant and stay just consolidating. When this stuff was a big buzz, when I first started using it, when level 2 became a thing, and I'm old enough and I watched the transition from open outcry into electronic trading. When these tools were made available to us, everybody was clamoring to it because level 2, that was the thing. You were really informed if you had this information. Where's all the yachts? Where's all the billionaires and the millionaires? If it was going to make you institutional minded, where's all the rich people that came up out of nowhere using it? Right. So, not to discourage you, but when I say institutional order flow, it's not this. You'll hear people say, ICT doesn't teach order flow. I don't teach this stuff because this stuff I have no faith in, and I know how to use it, but I completely cut it out of my analysis because I don't need it. You might need it. You may find helpfulness from it. It may allow you to feel closer to the marketplace. And if that's what you're feeling by doing it, then there's nothing wrong with that. Absolutely nothing wrong with it. Like I've already stated earlier, I have friends in this industry and I have students that use this stuff in conjunction with what I'm teaching, and they're profitable. So I'm not here to say this doesn't work. Okay. What I'm doing is I'm drawing a stark contrast between when I say institutional order flow, what am I talking about in contrast to this stuff here? That's what we're going to do. Okay. So let's move on into the discussion here. We're going to look at a case study on NASDAQ. Okay. And I'm going to spare you level 2 data because it's not required, it's not necessary, and I want you to think about how it is that I teach you and how I've shown a plethora of examples of before the fact, where the market's going to go, how it's going to get there. Not just here we are at point A, I believe it's going to maybe get up to point B. That's not what I say. I say this is where I think the draw of liquidity is. That means I'm cosigned. That's a directional bias. That means I have made my expectations known publicly beforehand. And it's not a 2 pip or 5 handle expectation. These are pretty considerate price moves. And I'm not utilizing anything that is classically lumped into order flow. Because folks that use that information, when I say I'm trading with institutional order flow, I'm seeing institutional order flow in price action. I'm going to cover that again today. I've done it in the past, but I want to present a little bit deeper presentation about it. And I want you to think about the lack of required tools that other people, other traders feel like they have to have. When I have nothing on my chart, it's simply a candlestick chart. And as long as I can see what time it is and where we are in the range, that's it. That's all you need. So the number one thing is draw on liquidity. So I was bullish. Obviously, I mentioned that last Sunday. And today is July 16th, 2023 at the time of this recording. So last Sunday, July 9th, 2023, I had outlined my expectation of higher prices on E-mini S&P, NASDAQ, higher prices on Eurodollar, and lower prices on the dollar index. And it was a clean sweep. Everything delivered as I expected. They were not small moves. They were rather large. And I want to go into detail as to why I believed that NASDAQ would go higher. And I want you to take a look at the chart here. Upper left-hand corner. This is the weekly chart. This right here, this candle right here, is a mitigation block. Now, I don't talk too much about it, but it is basically the opposite of a breaker, but they are still both mitigation in essence. Now, we have a high, a low, and a higher high. No, lower high. You see that? That low between it is a mitigation block. If this high here was taken out with a higher run here, then that would be a bearish breaker. Bearish breakers are much more stronger in terms of resistance than a mitigation block. A mitigation block can be traded through. So in terms of how I use mitigation blocks, I typically side with using them as targets more so than entry because they can be traded through. Breakers are kind of like, they're pretty formidable in the path of price action. It doesn't mean that they can't go through them. It doesn't mean I've never had a losing trade using a breaker, because I have. But mitigation blocks are better used for targeting purposes. I was using this one here with the expectation that the NASDAQ could try to gravitate towards that. If it were to go any higher, this small little fair value gap there, and obviously the buy side above it. So I have not called a high in the NASDAQ or ES. In fact, you've heard me emphatically state many times throughout the commentaries and or Twitter that I am not calling a high. And it's important for you not to try to do that too. Look how it just keeps drilling higher. It's grinding people down. Anybody that wants to sell short this market, and believe me, I'm in the opinion as well, that there's no justification for the markets to be where they are, at least for equities. Stocks should not be trading where they're at. But we have to trust order flow. What kind of order flow? The things I started to show you in the beginning of this presentation, I don't subscribe to those things. I don't have any faith in them. My faith is based on where I believe the market's going to go. So yes, I believe I'm pretty good at predicting where price is going to go because I have experience doing it and I have tools to help me to do that. And I also can see where orders are going to be anyway. Before your ladders, your depth of market, before your footprint confirms what I already and my students already expect in terms of price delivery, we already know there's going to be buying and selling between the 2 price points that we're at. That's a given. So knowing where the market's going to go to, that's a directional bias. Listen, at some point, folks, unless you trade options and you're delta neutral.
Hi, I'm Dana. I'm a filmmaker. Come with me to create an entire movie poster mock-up with the newest AI-powered.
You have to have a directional bias. There's no way around it. You have to. Otherwise, you're writing options. So if we're trading futures and we're trying to be a buyer or seller, I mean, if you're going long, then you have a bias that's going higher. So why argue with that? Why call it something that it's not? You're predicting price. You're trying to predict price. Then say we don't need to predict the future price direction. Well, yes, you do. If you want to be profitable, or at least consistently profitable. Like, you have to have an understanding of where the market can gravitate towards. And that's what I teach my students. That's the first thing they come out of the gate with me, is knowing where price is likely to go. If you don't have that skill set, you will not be consistently profitable, period. End of story. There's nothing else to discuss. So my opinion was, in the beginning of the week, I wanted to see us gravitate towards this mitigation block. It would be above the relative equal highs here that had already been cleared through here, and we consolidated. Markets don't top like that. Okay, and it was more likely that we're going to expand higher. It did. It reached into the mitigation block. It actually closed right on it. So that's rather decent, isn't it? So ahead of the week open on Sunday, July 9th, 2023, we were expecting price to go higher. And we have this candle right here. Now, on this candlestick chart here in the lower left-hand corner, this is a daily chart of the NASDAQ. Everything that I'm teaching you here, folks, you may be primarily a Forex trader, okay? Everything that I'm teaching you right here works on every asset class. I would not do anything different. So that way, if you're frustrated because I'm not talking about Forex like I did a lot before, I'm teaching through this medium here because this is where I actually got started. In 1992, I was a commodity trader. So this is where I started. Later on in my career, I moved and transitioned to Forex. There's a lot of things that prevent me from wanting to trade Forex, so that's the reason why I'm teaching with this medium here. Everything that I'm teaching you here with futures index trading works in Forex too. It works in commodity trading. It works in gold. It works in metals. And my students, I can't swear by it because I've never traded crypto, but I have students that have been profitable trading crypto using this information. So that way, at least you know that somebody else out there other than me has some experience with it, because I don't have any experience trading crypto. So if we see this down close candle after, if you look at the weekly chart here, there's a small little fair value gap right in there. That's this one here on the daily. So the market traded higher there. And then we have this down close candle, which is right above and digging into this down close candle. This is an order block. It's bullish. This is a propulsion block. Propulsion blocks are order blocks by themselves, but the way you differentiate what they are and how they're used is this down close candle digs into a previous down close candle. So an order block that has another order block that digs into it. Propulsion blocks, you never want to see a closing price below mean threshold. Mean threshold on an order block is the 50% level. We wicked down through it, but then closed here. This one here, we wicked down through it and closed right here. We wicked down through it and closed up here. So yes, we had the movement through the mean threshold, but we didn't close below it. So that still keeps this down closed candle valid as a propulsion block. I promise you we're going somewhere. Friday, Thursday, Wednesday, Tuesday, Monday's trading. All of this movement here was just returning back into this gap, this tail in this candlestick. We treat wicks and tails on candlesticks as gaps. Midpoint of that gap or tail in that candle is consequent encouragement. Extended out in time, you can see that's exactly where we were trading on Monday. It did not violate the rules that make a propulsion block invalid. Market closes here, and now we open the next day. We open, trade down, rally back up, and have an up close. So the next 2 days we had news. We had pretty good economic calendar events for the rest of the week, and it sent price parabolic above the relative equal highs. So the draw on liquidity is the weekly chart mitigation block. Okay, so we're not going to say that the actual price was 15,693, but we're just going to use it for the sake of discussion because I don't know it off the top of my head what the actual price was. I have it noted here. You're invited to do that in your own study. Don't just take what I show and talk about in the video. You need to go in there and weigh out whether your charts show the same thing, because you want your own proof. You don't want to just take my word on anything. In fact, that's the best way to do it. Challenge yourself and challenge my observations. Was it really there in the chart? Because just taking my word for anyone else's word for anything is not something you should do, especially investing in financial advice. So this movement here, this was fully expected. We were expecting this bullishness and higher prices on NASDAQ. We were expecting it in ES as well, meaning S&P. But we look for things to start or instigate a price rally higher or a price decline lower. And we frame it on the basis of where are we at right now versus where is it likely to go. So if we think that the price is going to gravitate up to this area here, and we'll call it 15,693 and 0.75. If we start the week here, Monday, and then Tuesday, and Wednesday, and Thursday, and Friday, we expect each daily candle to gravitate towards that level. Even if you didn't pick that level, if you felt that this fair value gap was a reason to keep going higher, that's fine. There's nothing wrong with that. But this mitigation block is below that fair value gap. And if you are using the relative equal highs as a draw on liquidity, there's nothing wrong with that either. Remember, the only thing we're doing is primarily looking for the expansion either higher or lower on the weekly candlestick. That sets our bias for the week. So is it more likely to see where price was consolidating here? Is it more likely it's going to drop down after we've already went into this fair value gap here? We already did that. And then we consolidated here the previous week. And then we start a new week here, trade down a little bit, and then reject it, which is all that rejection is based on this consequent encouragement, this daily candle right there. That's where the low of the week was formed. So this is primed to just obviously expand higher, aggressively above these relative equal highs on the daily chart. So there's buy orders resting above that. Markets don't top like this, folks. They don't do it. And since the weekly and the daily chart are showing this pattern, it's more likely to go higher, especially since we were bearish on dollar. Not just bearish a little bit, but we were exceedingly bearish, expecting it to reach for a larger pool of sell-side liquidity. So if that is the case, that means it's definitely a risk-on scenario, meaning all assets have the likelihood to go higher. Euro, pound, gold, all other asset classes are free to move higher because it's risk on. And we saw a huge risk on event this past week where most asset classes went up while the dollar crashed. Over here on the hourly chart, I want you to notice this little shaded area here. That's the propulsion block. That's this whole range here, but visible on a hourly chart. So we have relative equal lows here. We drop down into it. We trade above this short-term high right there. That's all it needs to do. That's a shift in market structure. It doesn't need to close above it. It just now sets the thing in motion that we're going higher. Doesn't mean you can't have retracements, but look where it retraces. If you take this propulsion block right here and you divide it in half, that's mean threshold. That's what this drop was going to right there. It's going right there, and it's also cleaning up these smooth edges in the bodies. Wait a minute, that's not smooth edges, ICT. Look at this wick right here, or this tail, and look at this right here. Look at the bodies. The bodies tell you the story. That's the narrative. The wicks do all the damage. That's the stuff that everybody gets hurt by. You get stopped out and you don't want to go back into the marketplace. That's their purpose. Reading price action with a time-based chart and focusing on the bodies of the candles. If you just saw these right here like this and there was no wicks or tails on your candlesticks, if you took that completely off your chart, this would look like smooth edges. And that's all this was, trading down into mean threshold, which is the entire range from high to low. Split that in half. That's this level right here. That's occurring right in this level, digging into it after we had a shift in market structure. So what am I saying here? At this point, right there, that's slightly higher high than this one, because we've had sell side taken there. Now we have buy side. We're bullish. So we have now met the minimum criteria for high probability directional bias. So now we can absolutely predict higher prices. We can trust that higher prices are likely to go where? Up in here, this mitigation block. So if we're looking for a 15,693 level, and we're down here and we drop down to mean threshold, at that point, does the market want to rally away from it? Sure looks like it does to me. Tries one more time, digs into it, but look where the bodies are showing. They're showing it's respecting that propulsion block right there. We've already did the damage of going down into it, and here bodies are supporting the high end of the propulsion block, that shaded area. And then we want to see, does the market want to rally? Well, here's the thing. If you're looking at depth of market, or if you're looking at footprint, you're going to start seeing all the things that would justify the market wanting to go higher. We already knew that. We already knew all those things. And from here, as soon as we get these candlesticks showing this, and this candlestick closes, the next candle here, and it drops down and touches this the high of this blue shaded area, which is this candle, that range on the daily chart. We're working with the hourly chart here now. I know that we're likely to go higher. Where? We have all this sell side imbalance, buy side inefficiency. So basically this candlestick's low. And then we have the buy side above this high here. There's buy stops resting above that. But this also is another pattern. It's a breaker. So I know that everyone that uses a depth of market, uses a footprint, they're going to be looking for justifications to go higher or lower. The folks that would be looking at it with the expectation that the market's going to go higher, the evidence that they're seeking will be there. Every instance of it would be reflected in those tools. I don't need to see that. I already know that the market's going to go towards these levels. It's driven that way, not because of buying and selling pressure. I have already arrived at these ideas before the market's even opened up, before the market even printed its first book on Sunday's opening.